Everybody. I hope everyone is having a good week so far. I know it's only Tuesday, but today, though, is a very special Tuesday because it is a tax Tuesday. And today, every Tuesday, we do an AMA, an Ask Me Anything, all about taxes. How do you structure your business? How do you pay your taxes as a self-employed individual? What's the best way to pay your taxes? There's several things that to keep in mind when you're thinking about a self-employment tax situation. Um, and my name's Luke, and I'm a business advisor here at Collective. And we are your all in one solution for your taxes, accounting, full service bookkeeping, payroll, LLC and S Corp formation, and business tax return filing. We do it all. We handle your paperwork so you don't have to. You can focus on running your business. But today, I'm here to answer your questions. So please throw them at me. And I believe we already have some that have come in. Let's see. This one was asked during our last week's Tax Tuesday, but I think it's particularly important, so I'm going to do it one more time. The question was, do you have to pay quarterly taxes if you just started your business and aren't profitable? So you're generally required to pay quarterly taxes if you expect to owe at least $1,000 in tax in that tax year. So even if you're not profitable right now, currently, you could still owe estimated taxes and you could still be required to pay them even in the first quarter when you're not making money. So let's say that the first half of the year you don't make any money, or you're making money but your business expenses are overturning or are more than your income. You're at a loss. Your business is at a loss, and technically, as of now, that business does not owe any tax. But let's say that you become profitable in the second half of the year, and you determine that you're going to owe some taxes. It's going to be more than $1,000. In that situation, technically speaking, you're required to pay estimated tax deposits quarterly, even in those first 2 months of the first 2 quarters of the year that you weren't profitable. Doesn't matter. Since you're gonna owe tax in that tax year, it's important to pay those quarterly deposits. I worked in Texas for more than half of the year, but my Florida address is in California. Will I owe California taxes? Let me see if I can determine that. Let me see if I can figure out that question. One second. Let me think about that. Okay, I see. I worked in Texas for more than half of the year, but my driver's license address is in California. Will I owe California taxes? Well, that depends on if you did business in California. I mean, where you pay taxes is where you reside, and where you do business. So if you've just kind of worked in Texas for half the year, but you live in California for the rest of the year, yeah, you will likely owe California taxes. But just having a driver's license address in California does not necessarily mean you owe taxes in California if you don't live there. Now, they might send you a letter, asking if you've done business in California, things like that. And if you have, they'll, tax you and want you to set up an LLC in California and all that kind of stuff. But just because you have a driver's license address in California does not necessarily mean you owe taxes in California. You have to be living there. Are you at risk of audit if you hire your parents? Ooh, that's a good question. So usually the question is, are you at risk of audit if you hire your children, your kids? Which, yes, you are. You're at risk of audit. But yes, also, I would say absolutely. You're still at risk of audit if you hire your parents. You're at risk of audit if you hire family members in general. It doesn't mean, just because you're at a higher risk of audit for something doesn't mean it's illegitimate. It doesn't mean that you can't do it or that it's not allowed or that it's illegal or anything like that. It just means that you're at a higher risk of audit. It's a riskier tax strategy. And at the end of the day, hiring family members has a larger chance of abuse in the IRS's eyes. It has a kind of a larger sort of chance of people taking advantage of that. So yeah, it will increase your risk, but it doesn't mean you shouldn't do it. Do I recommend doing an LLC in California? Well, if you live in California, yes, I would recommend doing an LLC in California. Because one thing is LLCs provide liability protection. That's the first obvious thing. But also, when you form an LLC, you can become an S corp. You can make an S corp election, and that's advantageous tax wise. So, yes, I would say overall, if you're doing business in California, set up an LLC in California. Now, of course, there is and a lot of people that live in California already know this. There is an entity tax at minimum of $800 a year when you form an LLC in California. But with an S corp, you could save thousands of dollars. So it quickly becomes worth it. Can I pay my husband cash to help me with media task in California? Yeah. I mean, there's no problem with paying your husband cash. If you wanted to write it off, I mean, he has to claim it as income in the IRS's eyes. And if you would like to write that off as a business expense, then you would need to record it in your bookkeeping. Because if you're paying him in cash, if you have an accounting software or a bookkeeping software, it's not going to automatically pick up that deduction because there is no deduction in the bank account. Excuse me. But if you pay him in cash, you can still write it off as a business expense, but he would just need to claim it as income. What is an S corp? What is an S corp versus an LLC? Well, that's a great question because an S corp or an S election is an advantageous tax structure for a lot of self-employed individuals. And really, the first thing that I would say is when you're thinking about an S corp, realize that it's not a business entity. It's not a business structure. It's not a corporation or an LLC or anything like that. It's not a business structure. It is a tax structure. You're taxed in a certain way when you make an S corp election. And the difference lies is when you're in the US, when you're thinking about taxes, you're thinking about two groups of taxes, typically. You're thinking about the income tax and the self-employment tax. Those are the two groups of taxes that business owners have to deal with. And before you become an S corp, essentially all of your money is subject to the self-employment tax, which is a flat tax rate of 15.3%, flat rate. Before you become an S corp, all your money is subject to that tax rate. So let's say that you made $100,000 in your business. Before you become an S corp, how you come up with your self-employment tax is you take $100,000 times 15.3%. You pay $15,300 in self-employment tax. But what happens with an S corp or an S corp election? That's the technical name for it. The first thing you do is set up an LLC. That's the first step. Then you make an S corp election by filing paperwork with the IRS. It's done with the feds. And what that does is, technically speaking, you go on payroll. You become an employee of your own operation, of your own business, of your own LLC, technically speaking. And since you're an employee, you pay yourself a salary. Your business pays you a wage, just like you would make or just like you'd receive if you work for someone else as a W-2 employee. But the cool thing or the advantageous thing about S corps is that the only chunk now with this new tax structure, the only chunk of your money, of your earnings through your business that is subject to the self-employment tax is your salary now. The rest of it is what we call a distribution, which you can kind of think of as dividends. It's still your money, it's still income, but it's taxed at lower rates than what a salary is. So, for example, let's say you made $100,000 And let's say that a reasonable salary for you is $30,000. Let's say you choose to pay yourself 30 grand in W-2 income in this new S Corp tax structure. That first $30,000 is still subject to the self-employment tax. You can kind of think of it as a payroll tax on your W-2 income, 15.3% on that 30K. The rest of your money, the 70K, those are your distributions. And that chunk of money is not subject to the self-employment tax at all. And it's still your money. You can still pay yourself these distributions whenever you'd like. You can access your money at all times. You don't have to leave it in the business account. Matter of fact, it's advantageous just to pay yourself distributions as soon as you can. But that chunk of money, it's not subject to the self-employment tax. And I should be able to do this in my head. It's shameful. I'm a tax man. I'm embarrassed. But the tax savings that you'd get in that sort of situation would be close to $11,000. It'd be $10,710 in tax savings in the self-employment tax. So it's, as you can see, it can be extraordinarily advantageous. For someone within an appropriate income range, you can save a lot more of your money by electing this tax structure. How can I hire you? My accountant never mentioned this. Well, unfortunately, accountants don't necessarily always specialize in tax structures like this. They can be great professionals, but they're focusing on other things. Like they're focusing on filing personal tax returns that they've done forever. They're focusing on financial reporting and auditing and things like that. They don't know much about tax structures sometimes. And you can absolutely hire us. And what you can do is send us a message on Instagram, ask for a link to schedule a call. And you can speak to someone like me, and we'll go through your situation and go through your business, and we'll see if an S Corp is right for you. We'll see if collective is right for you. And we can talk about next steps. Okay, let's see. Do I have to have employees if I choose to do an S Corp election? No. The only employee that would be in your S Corp would be you, because you are becoming an employee. You are going on payroll with this new tax election. But no, of course not. There is no requirement, excuse me, to have employees when you have an S Corp. So no. Okay, let's see. How is this not a loophole? No, it's not a loophole. So a loophole, here's the definition of a loophole. A loophole is when something is in the tax code or in legal code in general that creates a sort of undesirable or unintentional effect based on the rules. So there's some, like, for example, there's some loopholes that allow people to evade taxes because they take advantage of, different rules and different sets of the code and whatnot. But an S Corp, the S Corp election is not a loophole. The S Corp election is a straightforward addition in the tax code. It's something, it's not an intricate sort of, something random that someone's come up with based on an intricate, application or reading of the law or anything like that. It's straightforward. It's something right in the tax code. And really what it is it was a response by Congress to people that lobbied them and said that, self-employed people, small business owners were paying a lot in taxes, and it needed to be relieved somehow. And the reason that is because the self-employment tax, the flat 15.3%, another name for that is Social Security and Medicare taxes. That's literally what it is. That is what the 15.3% is made up of. So when you work as a W-2 employee, for someone else, like for a corporation, for just anyone. If you're an employee working for someone else, you still pay self-employment tax in effect on your paycheck because you pay Social Security and Medicare tax. It's the same tax rate. The only difference is whoever's employing you as a W-2 employee, your employer pays half of that tax rate for you. Just by law, they have to do that. When you're self-employed, when you're 1099, you have to pay the entire tax rate yourself. It's subject to the full 15.3%, and you're on the hook for the entire thing. So what happened was when people, especially now with the invention of the internet and just more opportunity for people to start businesses and go off on their own, they noticed that when they quit their W-2 job to start their business or start consulting going forward, they noticed that just immediately they were paying a significant amount in taxes, just a big jump, more taxes than what they paid when they were employed as an employee. They were making the same amount of money, but they noticed their tax bill jumped up by thousands of dollars. And the reason that is because they pay more in self-employment tax. But so what they did is they lobbied Congress and they said, hey, we need to work something out here, Congress. This is too much. This is too many taxes to pay. You're going to need to cut us a break. So Congress responded with the invention of the S Corp election. And it recognizes that a small business owner doesn't need double taxation like corporations. You don't need a suite of a vice president, a CEO, a board of directors. You don't need all of that. You need a way to minimize your payroll taxes, but still remain a small business. And that's where the S Corp comes in. And Congress responded by sort of writing that election into the tax code to help mitigate these taxes for small business owners and for the changing of the landscape. There are a lot more self-employed people in general than there were back in the day. So things just need to be sort of structured a little bit differently. If I'm paying less in self-employment tax, which is also the Social Security and Medicare tax, does that mean I'll receive less Social Security upon retirement? Yes, that is absolutely what it means. But here's the good news, though, or the bad news, however you choose to look at it. Social Security, when you pay into Social Security, the self-employment tax, the Social Security tax, that's what it is. When you pay in that tax rate, you're paying into your Social Security. Or when you work as a W-2, when you see those FICA taxes, those Social Security and Medicare taxes, you're paying into your Social Security, which you will then receive back at retirement in the form of payments, in the form of monthly payments. But in the meantime, though, those Social Security payments that you're giving to the government or that the government is taking from you, the government is investing in treasury bills, which have a terrible rate of return. You don't make money off treasury bills. They're not a good investment. So Social Security is not a good retirement strategy. What a better strategy, if you're concerned about retirement, if you want money when you reach an advanced age, you should take that money that you're saving with an S Corp, that you're saving in the Social Security tax, and you should throw it into a self-employed retirement account. You should save for retirement. You should take those extra savings and you should put it towards investments, and you should put it towards retirement and obtain a much higher rate of return than you would be if you had your money in the Social Security system invested in treasury bills. It's a much better idea to route more of that, as much as that money as you can, away from that system and put it in your own retirement accounts. You will make, for example, it could literally be hundreds of thousands of dollars in difference. That if you've ever heard of compound interest, that's a concept that's thrown around a lot online by a lot of financial influencers and investors and business leaders. The sooner you can get money into a higher rate of return investment vehicle, it can make you rich, really can. So these things, when you're self-employed, it's when you're working hard, when you're putting, hours, sacrificing hours of your week into your business, building your income. It's important to keep as much money as possible to build your business more, to take care of your family and your needs. Okay. What are your thoughts on Airbnb versus a second business location in terms of write-offs? Um, Honestly, for that, I'd have to have more details. We'd have to have a conversation about that. If I'm a dog groomer and I use my garage as part of my location, and to house the pups, can I write that off? Yes, you can. You can write off that area of space, your garage. How do I write off personally? Or no, I'm sorry. Can I still write off personal expenses if I have an S corp? Well, it depends on what you mean by personal expenses. Now, you can still take the home office deduction, which is a portion of your personal, mortgage, interest, or rent, a portion of your utilities, your HOA bill, required payments like that. You can certainly still write that off. So now it's done a little bit differently. It's a little bit more complicated with an S corp. With you're an S corp, it's something called an accountable plan. And when you're an LLC or a sole proprietorship, you can actually just write off those expenses directly. You can write them off directly from your business account. It doesn't really matter how you want to do it. But when you're an S corp, those personal expenses, you will have a separate business account, and those personal expenses will not be showing up in the business account actually. So it won't automatically be showing up in the account for, the accounting software so we can write it off, things like that. It can't be written off automatically. So what happens is it's a structure called an accountable plan. And it's a way that the S corp actually reimburses you for some of these expenses. And that reimbursement it writes it off on the company books. And thankfully, those reimbursements to you personally they're not taxed. It's tax free sort of reimbursements to you. So it's a little bit more complicated, but thankfully with Collective, we'll handle it for you. We'll handle the bookkeeping and everything like that. So it's not an issue. And yes, Becca Cuddles and Care. I love it. We sent you a link to schedule a call directly with me. So please throw some time on my calendar, and I'd love to talk through your situation. Can I write off my car directly from my business? Technically speaking, it is possible to write off your car from your business, and there's several ways to do that. Now, when you're a small business owner, especially when you're a consultant type person, when you're a service-based individual, when you're not driving a lot for business, it is not a good idea to write off your car. If you're anywhere near below 50% of business use in terms of mileage for your personal vehicle, don't write off your car directly from your business. But yes, it is possible, theoretically speaking, to write off your car from your business. Now, there's two ways to do it. One, you can purchase the car. The business itself, the LLC itself, can purchase the car directly, and then write off actual expenses, which are a portion of gas, a portion of your interest on your car loan, depreciation, things like that. That's the actual expense method. Or you can take what's called the Section 179 deduction. And what that is, it's a way, it's an essentially it's an accelerated depreciation method, and it allows you to write off more immediately on your car instead of over time through depreciation in that first year of purchase. So, for example, let's say that you buy a car and it's a $60,000 car, and you want to take the Section 179 deduction. There are limits to it. You can't write off the entire vehicle, but you might be able to write off. I forgot what the limits are. I want to say they're around $20,000, something like that. You might be able to write off $20,000 right off the top in that first year. Now, keep in mind, in that first year, you can't take any actual expenses. You typically can't depreciate it in that first year. You can only take off that, that amount right off the top. And then after that first year, after you've taken the Section 179 deduction, you can depreciate it in the preceding years each year. And I want to say you depreciate it typically for another 5 years. So if it's a $60,000 car, you write off, around 20 grand of it that first year. Then each year you divide it evenly in the next 5 years and write off, I don't even know what that is, like 16 grand the first year, 16 grand the next year, and so on and so forth. But what I would suggest, and what most responsible tax professionals suggest, is to write off mileage from your business, especially when you're a consultant or a service-based person. You're typically not using this depends on a case-by-case basis, of course, but you're typically not using your vehicle more than 50% of your usage. You're typically not doing that. So keep that in mind. It's usually better to just write off your mileage. And how you write off your mileage is you just keep track of how many miles you drive for a business, and you just multiply how many miles you've driven by the standard mileage rate. And you just write that off the top. Okay, I think I have time for one more question here. What's wrong? You mentioned earlier that it's risky to hire family members. I've always heard that it's totally fine to hire your kids. What are your thoughts on this? Now, listen, like I said, it's legal to hire your kids. There's nothing saying that you can't do that. It just, the IRS looks at that a little closer than they do with other actions in the tax code. So keep that in mind. That's the only thing. It's riskier that you're allowed to do it. It's just you're putting yourself more at risk when you do it. But I'm afraid that's all the time we have right now. I actually have another meeting with a prospective collective member. And so I'm going to have to let everyone go here. But thankfully, I will be back next week. We do Tax Tuesday every Tuesday. And something else I would say too is right now we are running a retroactive S Corp election campaign, and that is expiring at the end of June, at the end of this month. So send us a direct message, schedule a call, see if an S Corp is right for you, see if backdating your S Corp is right for you. And we'd love to talk through those issues with you. But until next time, I